Welcome to Talk Tickers, your essential shortcut to understanding the market-moving events from the latest earnings calls. We don't just read the reports, we really dig into the conversation that shapes the street's perception. And today, we're diving into Rent the Runway, that's ticker RTR. They just released their fiscal Q2 2025 results after the market closed on September 11th. And, well, these numbers presented a pretty spectacular contradiction, didn't they?
Oh, absolutely. A real head-scratcher, if you just glanced at the surface.
You've got a company dealing with some severe operational pain, a significant quarterly loss.
A big long, yeah.
Yet the stock just exploded. It jumped over 28% in after-hours trading. So our mission today is to break down this disconnect. What exactly was in that earnings call that made investors seemingly forgive these losses and drive the stock up like that?
That huge price jump. I mean, that really tells the story, doesn't it? If you only looked at the headline financials, you'd think the stock would tank.
Right.
The results were, let's say, mixed at best. They started with a beat on the top line, revenue, which was, a nice surprise.
Okay, what were those numbers? Revenue came in at $80.9 million. That actually surpassed the consensus estimates, which were around $75.5 million.
So decent growth there, year over year.
Well, modest. It translates to about a 2.5% increase year over year. So it suggests the underlying demand is still, present.
But as you said, that's where the good financial news kind of stops. Below that revenue line, things got, pretty ugly pretty fast.
Yeah, ugly is a fair word. That GAAP EPS, generally accepted accounting principles earnings per share. That was a big miss.
How bad?
A loss of $6.55 per share. That was way worse than the consensus, which was looking for a loss of around $5.48.
Okay, maybe for listeners less familiar, why the focus on GAAP EPS when management often points to adjusted figures?
That's a really important point. GAAP EPS is, the purest measure of profitability. It captures everything, including those non-cash items like depreciation, amortization.
Which must be huge for RTR, given all the inventory they own.
Exactly. Thousands and thousands of garments. So when GAAP EPS misses by that much, it signals that the underlying cost structure is fundamentally challenged.
Okay. So what about the metric management does prefer, adjusted EBITDA? Did that look any better?
Well, they certainly prefer it because it strips out some of those items and tries to show operating efficiency. But honestly, even that metric showed pretty severe weakness this quarter.
How weak?
Adjusted EBITDA was only $3.6 million. That's a tiny 4.4% margin.
Wow, compared to last year.
It's a really sharp decline. Last year, same quarter, they posted $13.7 million, which is a 17.4% margin. That's massive margin compression hitting them, like a tidal wave, as you said.
Okay, so the unit economics are clearly under pressure. But amidst all this, there was one metric that really shone, right? The subscriber growth.
That's the other side of the coin. Ending active subscribers hit 146,373. That represents really strong year-over-year growth, 13.4%.
And that's a big acceleration from the previous quarter, wasn't it?
Massive acceleration. So you have this split picture, right? The demand side subscribers, revenue performing quite well, showing signs of life.
But the cost side?
The cost side is collapsing the profitability structure. But the market made its choice instantly. That 28% after-hours jump just screamed that investors today weren't focused on the margin squeeze.
They were focused on survival.
Exactly. Balance sheet survival. They saw the potential end of that near-term solvency worry, and that trumped everything else.
Okay, let's unpack that. Because honestly, for the average investor, a nearly 30% jump after a big earnings miss and margin compression, it defies common logic. How did this recapitalization, this debt deal, manage to just overshadow everything?
It was the ultimate safety blanket, as you put it.
What?
Management framed this whole thing not just as a transaction, but as a pivotal moment. They even called it IPO 2.0.
IPO 2.0, strong words.
Very strong. They used that language to signal, the company's essentially being reborn, free or freer from that crippling debt load that's been hanging over it since the actual IPO.
Let's get into the numbers on this debt fix, because they really are transformative.
They are. They're slashing total debt from over roughly $340 million.
Wow.
Down to approximately $120 million.
That's almost 2/3 of the debt just gone from the balance sheet. That doesn't just free up cash flow, it changes the entire narrative.
Completely. And they also pushed the debt maturity way out to 2029.
2029, okay.
And secured an extra $20 million in new cash to help operations right now. But the mechanism here, how they did it,
Yeah.
that's where you see the real institutional confidence signal.
Right. Tell us about that. We know the existing lender, APS Arenda Principal Strategies, was key.
Yes. APS converted a really substantial chunk of its debt straight into common equity.
Yeah.
And we also saw new money coming in from Story 3 Capital Partners and Nexus Capital Management.
So it wasn't just refinancing, it was debt for equity plus new investment.
Exactly.
But wait a minute. If APS converted a lot of debt to equity, doesn't that mean massive dilution for the existing shareholders? Why would the market ignore that risk?
That's the critical tension, isn't it? Yes, dilution is absolutely a reality here.
Mm-hmm.
But in this specific situation, investors clearly viewed dilution as the lesser evil compared to, well, insolvency.
Okay.
The market was basically pricing the equity as almost worthless if that debt overhang stayed. So by converting debt, these big players showed two things. One, they believe the equity actually has value once the balance sheet is cleaner.
Right.
And two, they're willing to take that dilution hit now to secure a long-term position in what they see as a restructured, viable company. And what's really fascinating is that this whole transaction was priced at a significant premium to the stock price before they first announced it back in August.
So that was the early signal.
That was the big early signal that some major players saw future value there.
So the market essentially said, look, a smaller piece of a company that can actually survive is worth more than 100% of one heading towards potential bankruptcy.
It's a perfect way to put it. They bought themselves, almost 5 years of breathing room?
Yeah.
And that time lets them hopefully capitalize on the operational wins we touched on, especially that inventory strategy.
Okay, so let's loop back to that growth engine. That subscriber jump, Q1 was less than 1%, Q2 over 13%. That's a huge inflection. Management's pinning this on their big investment in inventory, right?
Absolutely. They made a huge commitment to inventory depth and just freshness. Management highlighted that the number of styles they posted just in July was up an incredible 253% compared to last year.
253%.
Yeah. And they added 56 new brands, 2,200 new styles just this year so far. It's not just more stuff. It's about keeping it fresh, relevant, keeping subscribers clicking.
And they said the customer metrics back this up, NPS scores.
Right. Their subscription app promoter score, NPS, hit a 3-year high. And they also track something called hearts per style.
Hearts per style. Explain that one.
It's basically a measure of engagement, of desire. How many times does a subscriber heart or save an item they see? When that metric is up 15% year over year, like they reported, it means 1, subscribers are finding more things they genuinely want to rent, and 2, that directly helps retention. If you feel there's always something new and exciting you want, you're much less likely to cancel. It's proof that inventory spending is driving engagement.
That sounds like the positive feedback loop they desperately need. Investment drives engagement, drives retention. But as you said earlier, this growth came at a steep cost, back to those ugly profitability headwinds.
Yeah, we got to face the music on the costs. That gross margin erosion was severe. It dropped 1,110 basis points year over year.
1,100 basis points. That's 11.1 percentage points wiped off the gross margin.
It's a staggering loss of efficiency in just a year, down to only 30.0%.
What hammered it so hard? Was it just buying all that new inventory?
That's part of it, sure, but there were two main operational drivers, and these are tougher because they're partly external pressures. First, fulfillment costs just exploded.
Shipping and handling.
Exactly. Reached 27.8% of revenue. Driven by higher transportation costs, think carrier rate increases, plus rising labor costs. It's inflation hitting them hard on the logistics side.
Okay, what was the second driver?
A high revenue share mix as a percentage of revenue. Basically, this means RTR is using more inventory that the company owns outright, rather than consignment or partner inventory where they share revenue.
Which gives them more control over selection.
Right. Better control, better quality maybe.
Yeah.
But buying that inventory up front hits the margins immediately before those items even start generating red revenue.
So high shipping costs plus paying more upfront for inventory equals, a brutal margin squeeze.
Precisely. Now, management's trying to fight back. They implemented their first price adjustment in about 3 years.
When did that happen?
August 1st. It averaged out to about a $2 increase per item, roughly. But critically, their popular 2-swap plan saw a pretty hefty 14% price hike.
14%? That's significant. Have they seen backlash?
Management reported on the call that the impact so far is in line with expectations. which usually means, they haven't seen a mass exodus of subscribers yet, but it's early days.
Right. August 1st means the full impact won't really show up until the Q3 results, which connects directly to their guidance, right, and the whole competitive picture.
Exactly. The guidance really reflects this tightrope they're walking between trying to grow and trying to control costs. For Q3, they expect revenue between $82 and $84 million.
Okay.
But the crucial number is the Q3 adjusted EBITDA margin. They guided that to a very, very narrow range, -2% to +2% of revenue.
-2 to +2. That window shows just how much pressure is on them to make those price hikes stick and actually turn profitable on an adjusted basis.
Huge pressure. And on free cash flow, FCF, those transaction costs from the big recapitalization deal are going to weigh heavily on the full year.
So what's the FCF outlook now?
FY 2025 FCF is now expected to be below -$40 million, largely because of those one-time costs for the debt restructuring. The underlying goal, though, stays the same. They still expect double-digit growth in ending active subscribers for the full year.
So the story really has shifted now. It's not, will they survive anymore?
Not in the near term, no.
It's, can they actually make this model profitable at scale? They bought time, but now they have to execute, convert that subscriber momentum into real, sustainable profit.
And they have to do it in a really competitive space. Fashion rental is definitely heating up again, but they're specifically fighting competitors like Urban Outfitters Nuuly.
Nuuly seems to be getting a lot of buzz.
They've been extremely aggressive, yeah. And reports suggest they've been gaining significant market share, putting direct pressure on RTR.
How's Nuuly winning? Price, logistics.
It seems to be a mix, but logistics and maybe just the simplicity of their model are often mentioned. Nuuly has a very straightforward, single-plan approach. It might appeal to a broader audience.
So RTR's response is?
Double down on what makes them different. The sheer breadth of their high-end inventory, that premium experience. Their high NPS scores suggest their core users value that. But yeah, the next few quarters are really a battle of unit economics. Can RTR's model handle rising fulfillment? Costs better than Nuuly's? That's the question.
Okay, well, this is Talk Tickers, so we kind of have to talk about the market implications when you see a stock move like this, so disconnected from the immediate bottom line, which brings us to the segment that is explicitly for entertainment and discussion only. This is definitely not financial advice.
Listeners, beware, absolutely. We're just analyzing the mechanics of market sentiment here, not telling anyone what to do.
Right. So we have to acknowledge this is super volatile now. A 28% jump after hours based on solvency, not profit. That's basically the definition of a stock shifting from being valued on fundamentals to being driven by momentum and technicals.
The thesis for that immediate pop is pretty straightforward. The debt deal took the biggest risk off the table. It removed the main reason sophisticated investors might have avoided the stock completely.
The bankruptcy risk premium evaporated.
Exactly.
Yeah.
Given that immediate spike, the huge daily trading range, the stock is firmly in momentum trader land now, fueled by that institutional stamp of approval on the recapitalization.
So if we were crafting an outrageous but plausible idea based purely on this market sentiment, the play would be betting on continued technical momentum, driven by news flow around this deal.
Yeah, potentially. It'd be
Yeah.
a short-term volatility play. The idea hinges on management giving positive updates about the official closing of the recap deal. Remember, it's expected by December 31st.
So confirmation becomes the next catalyst.
Any announcement confirming it's done, sealed, dusted that would signal the path is clear to focus entirely on growth, debt fears removed. The market loves hitting those milestones, especially ones that confirm survival.
Okay, but the risks here are obviously enormous.
Oh, absolutely extreme. Massive downside risk if, say, that 14% price hike does cause a big spike in subscriber churn in Q3, which we don't know yet. Or if those fulfillment costs just keep rising and prove impossible to manage. But the potential upside in this purely speculative scenario relies on the recap getting confirmed smoothly and that subscriber momentum carrying through the holiday season. It's essentially a bet that the market keeps focusing on the extended runway and ignores the messy unit economics, at least for a little while longer.
A fascinating, definitely high-stakes scenario to think about analyzing that sentiment driver. But again, purely for discussion. Let's wrap this deep dive up. So, to recap, Rent the Runway pulled off a major balance sheet restructuring, slashed debt by nearly 2/3, pushed maturities out to 2029.
A huge strategic win on the finance side.
And that move completely overshadowed what was otherwise a mixed operational picture. Great subscriber growth, good inventory engagement.
But really poor gross margins, crushed by fulfillment costs and that revenue share mix.
So what does this all mean for you, the listener?
Well, the market essentially gave RTR a new lease on life, a fresh runway. The pressure now shifts entirely to management execution. Can they translate that inventory investment and the recent price hike into actual sustainable profit improvements?
They have to prove the growth engine can fund itself before that 2029 debt deadline starts looming again.
Exactly.
And that leads us to our final provocative thought for you to chew on. Will this big inventory investment and their first price increase in years be enough? Enough to fight off competitors like Nuuly and actually hit positive adjusted EBITDA margins in Q3, like their guidance suggests is possible?
Or will those structural costs, shipping, handling, inventory ownership, continue to just eat away at any revenue gains they manage to achieve?
The race is definitely on. Thank you for joining this deep dive. And a final reminder, this analysis is for informational purposes only, not financial advice.
We appreciate you trusting Talk Tickers.